Good morning. Thank you for joining us at Capstone Coffee Conversation. My name is Ryan Skogstad, and I'm joined by Brian Felshaw. And it's been an interesting first beginning of November. So we thought we'd talk a little bit about the markets and what we've seen recently and any potential things to look forward to. Before we get started, if there are any questions, though, please type into the chat and we'll try to answer any questions that you might have when we get done with a few comments, and then Moesha will be able to share this with us. So we had the election a week ago. Today, it has come and passed, and we are all still here, and so that's good news. We're going to talk a little bit about where we see some opportunities and maybe things to be cautious of, but by and large, the stock market, as we entered the election, has had a really good 2 years. 2023 was excellent. 2024 through October was very strong as well. And so markets have been doing well by all accounts. And we entered into the election week with pretty elevated valuations. And since then, we've seen some pretty strong performance. I'm going to let Brian get into that. But as we see the markets in total, election or non-election, a lot of the things, regardless of who won, does kind of remain the same as far as pricing of bonds and interest rates and pricing of stocks. And so a lot of that remains the same. But I'll let Brian kind of dive in and look at some of the things that now that we know who the election winner was, what things we should be looking for as we go forward.
Yeah, I think first off, a big theme that every investor needs to examine is the relationship between US domestic investment versus international. It's safe to say that one of the Trump administration's talking points has been trying to promote US investment for businesses. And we're seeing this pricing into the market fairly quickly. So in the last 5 trading days since the election, we have the Dow up 4.9%, the S&P up 3.8%, and the NASDAQ up 4.4%. Versus international markets, the IFA is down 1.3%. So we can see a clear assumption there that the markets are pricing in likely more incentive for US companies to grow. And the big point behind that is the potential tariffs. The thought from the market so far is that this would hurt international companies' performance relative to US, and you're seeing that being priced in. I think one fair point to make is that the effects of the potential tariffs are largely unknown. We don't know for sure how that's going to play out. At the moment, the last 5 days, the market thinks it's going to be one way, could be different a month from now. We don't know yet. One thing to note as we look back at the Trump administration's first term, that the market was largely unprepared for tariffs and had to adjust quickly to the China tariffs, and companies had to adjust on the fly. Since 2020, we've seen a very large growing trend of companies diversifying their supply chain. In COVID, companies got interrupted, they had trouble getting products, and they wanted to avoid those same issues. So they started to nearshore or come back to the US, or at least diversify and have different supply chains so that wouldn't be interruption again. It stands to reason that potentially could help markets be more prepared for tariffs, however they play out this time around, as opposed to the first time around.
One other piece that we've seen do extremely well as far as in the stock market is we've seen small cap companies come out of the gate very strong in the last week. The small cap index is up almost 8% in the last 5 trading days. And again, a focus on kind of robust US growth can really help those small companies, where a lot of the larger companies trade more globally. It's much more of a global stock market. But when you're looking at trying to bring things to more of a US production, that really helps some US small cap companies. So those have done very well. And those have been priced a little cheaper as we went into the election. US large cap has done extremely well over the last 2 years. Small cap has done well too, but we're not as mispriced as the large cap index. The large cap index is, over the last 30 years, it's up it's up to percentages that is rarely seen in an expensiveness category. And so adding to those small caps is something that has really helped in the last week, and we've kind of been there. I think the important thing that I would bring it back to is, in a diversified portfolio, we're going to hold some US large caps. We'd like to hold international, and then also small companies. And when you hold a diversified portfolio, you might not always be, well, by definition, you're not always going to be performing better than any one of those pieces. But you always also will not be performing at the lower end of any one of those pieces. So what diversification might take out the outperformance of everything, what it does provide is a predictability of returns and a reducing of volatility. So we've seen small caps do very well, which we've had a piece of at 8% in the last week, along with large cap, while international has taken a small step backwards.
Yeah, it seems the more things change, the more they stay the same, right? US large, still stretched, maybe even more stretched now at this point, right? So the next thing to examine are the Tax Cuts and Jobs Act. So the tax cuts that we've had the last few years, the current tax laws, are set to sunset by the end of 2025, meaning we go back to the previous tax laws, or the government needs to propose something new and actually get it passed. With a Republican House, Senate, and presidencies, we're likely to see at least that probably be renewed and have no changes, or potentially an additional tax cut. It depends on how they play that out. What we aren't likely to see is probably an increase in tax rates, unless they don't get something passed. But I think it's likely that they would probably renew, or at the very least extend, the current laws for a couple more years, depending on what they agree on. In general, the takeaway here is that the markets are happy when things are predictable. The market doesn't like having big unknowns, and taxes are a big unknown, because these tax changes apply to both the corporate tax rate and individual tax rates. So if the market can price in that corporate tax rates are going to stay the same, the companies don't have to adjust for that, generally the markets are going to be pretty happy about that.
You know, the benefit in the long run of the lower taxes is that it can put more money in people's pockets, or put more money in the growth of companies, and over time that makes up for the lower tax rate, right? People are doing better economically, so more money is flowing through the system, and so that makes up for any tax cuts. In the short run, what could happen when you see it, you know, tax cuts get extended, or even lowered potentially in some areas, that could increase spending to the point where inflation ticks back up again, right? So inflation's been coming down from a very elevated level of over 9% a couple years ago. Now it's a little bit more manageable in the low threes. And if we do see some more economic activity quickly, we could see inflation tick back up. We could see interest rates tick back up, right? So that would be the short run, or the short term cautionary tale would be just to be cautious of interest rates and inflation starting to tick back up if it looked like there's going to be more robust policy coming forward quickly. One thing that we also have noticed, we've had a chair of the SEC who so far has been very anti-crypto type of investing. And President Trump has been very adamant about promoting people in charge of finance arms of government who are pro-crypto. So we've also seen Bitcoin do extremely well, up about 25% since the election. Ethereum up about 38-39% since the election in just 5 days. So if people are promoted to areas where they are more pro or crypto friendly, that could become even more and more of an investable asset class. And so we're seeing a really big tick up in investments in crypto over the last week.
The flip side of that, looking at the crypto markets, it's usually a barometer for folks who are worried about the government debt. And if tax revenue is likely to stay the same or potentially go down, and the spending continues, we would see an increase in the budget, the spending deficit by the US government. And so I think the crypto markets are kind of a barometer for how do we counter that, right? How do we counter that? The US dollar potentially having issues if the budget deficit continues, and that remains to be seen. We'll have to see how that plays out. Last but not least, energy, oil and gas production has been a big talking point as well. the U.S. production increase in U.S. production of oil is likely to increase. And in the last 5 days, we've seen the energy index be increase 4.6%, presumably on this being good news for the energy index. However, lower oil prices don't always mean a good thing for energy companies. It depends on what type of energy the company they are. So one thing to keep in mind is as oil prices come down, typically that benefits companies that are mid to downstream in production, rather than the ones actually drilling up oil, their end product they're selling at a lower price, whereas others who are refining, their input is at a lower price. So the energy discussion is going to be probably mixed. The results, I think, is totally unclear at the moment, even though the market is pricing in, this has been a good thing so far. I think it's safe to say that how that shakes out remains to be seen.
And one thing that, just to kind of close some of our comments, is we try not to be in front or making predictions on here's what we know is going to happen with tariffs, or here's what we know is going to happen with small caps or crypto. But we try to look for relationships and where we see value, trying to just avoid areas that might be extended or expensive in a manner, and then trying to allocate towards areas that look historically cheap with opportunity. All right, so trying to not be predictive, but trying to be a little bit just going to where the puck might be, but in a diversified manner. So with that, thank you for listening, but I'd like to turn it over to Moesha and see if we have any questions.
Yes, so I do have a few. So would you like a rapid fire or one?
Let's do one at a time. Yeah.
Bitcoin as an investment long term. I guess just maybe
Just
thoughts on that.
Yeah, want me to do it?
Yeah, sure.
Okay. I have been, as long as you have the stomach to handle the volatility, then I am comfortable with owning it as an investment. I think over time, it's becoming more of an adopted asset class. You're even starting to see some governments adopt it as a backup currency. And so where it hasn't been utilized much yet is in institutional type portfolios. But the more and more that it becomes a mainstream investable asset class, kind of like gold ETFs, the more it's able to be held in typical type of client accounts, then I think you'll start to see that wider adoption amongst bigger players. So I continue to like it for a very small and measured amount, because it does carry a lot of volatility, but at least having a toe in the water, I feel like can make some sense.
All right, next one. Will interest rates drop for new home buyers?
So heading into the election, the Federal Reserve was posturing that they expect rate cuts, and they certainly did just a couple of days ago, cut the federal funds rate, the short-term overnight lending rate between banks and the Federal Reserve, by 0.25. So they've cut it once previously, 0.5, and they cut again 0.25. However, they've indicated that they're very dependent on the data. So if economic activity picks up, as Ryan said in that scenario, when inflation ticks up, I think we're likely to see them pause and wait to see how that data plays out. And I think they've been consistent with that. So the expectation is that if inflation continues to come down and the jobs reports are where the Fed wants to see, that they're likely to cut. And we can see that benefit the 30-year mortgage rate and make it a little easier to buy a house. But it honestly really depends on how that data plays out. If economic ticks up and inflation ticks up, that they may not happen. So so far they've been consistent, but it depends on where the data goes the next few months. When is the next Fed meeting, right?
It's going to be, you just had it, so it's going to be either late December or early January.
December or January. That would be the next one to look for.
And we've also, what we've seen so far is the Fed has lowered rates, as Brian mentioned, 75 basis points in the last 2 months, but mortgage rates have gone up, right? And I almost think that we need to get accustomed to rates in the 6s, maybe even 7s, where they're at today. That has been still very low, historically speaking. The days of the 3, 4s are, I think, going to be very difficult to get back to unless we see the Fed lower rates to 0 again, and we have an extremely low inflation for a long time, or a huge calamity. So could we get to the 5s again? That's, to me, that's a maybe, but I don't think that we're moving there quickly. 3s and 4s, I think, would be very difficult to get to for a while, barring barring any unforeseen circumstances that hopefully we don't have.
That's a good question.
Inflation returning under Trump's policies.
Kind of touched on that a little bit. I think we could have, you know, if tax cuts get extended and corporate taxes or if taxes get lowered, you could see some economic stimulative activity quickly. And then in a little bit of a shock, you could see inflation start to tick up if people all of a sudden have more money and spending picks back up again. So there could be a little bit of inflationary raise there. Tariffs would also be a reason that you could have inflation. But I think that somewhat remains to be seen. But I think the first time around that Trump was president for 4 years, we had extremely low inflation. So hopefully they have their finger on the pulse there and try to get back to those types of those 4 years, because inflation was actually really low, even though we were starting to increase tariffs and had low taxes then.
Similar point to the 30-year mortgage rate. It's probably going to be tough to get back down to 2% at this point. Who knows? Maybe we will, but getting used to that 3% marker, 3 to 3.5, kind of where we've been in, gosh, the last 12 months, it seems like, is probably likely. We'll have to see.
Is the market overvalued?
The great question. Yeah, I'll give some thoughts. So, I mean, I think we've actually been talking about valuations for a long time now, because we have some areas of the market that are historically stretched, right? We're talking about the big 5 tech, the Magnificent 7, large growth. Certainly by its historical parameters, it seems high. It seems high compared to its source of historical average. However, those companies are producing a lot of value, and perhaps those valuations are justified if their future earnings match what the market's expecting. The problem with that is the market is expecting a lot. And historically, there's ebbs and flows to the business cycle and how these technologies take time to actually start producing value. So I think areas of the pockets and areas of the market could be overvalued depending on what you're looking at. As a whole, I think it's a tad overvalued looking at the historical norms, but that doesn't necessarily indicate that it's a bubble that's going to burst. Things can stay overvalued for many, many years.
There's a lot of cash still on the sidelines, and the consumer confidence is still under average. So even though markets might be a little overvalued, I absolutely agree. At least we are not, I don't feel like Brian's mentioned, we are not in a place where there is just wild investment or kind of the irrational exuberance. Definitely could have pullbacks though because of valuations at any time. So that is possible. And sometimes markets on the upside or the downside the markets go farther and last for longer than you would think, right? Okay, markets are expensive. They're going to come back down. Not necessarily quickly. And the same on the downside. Markets are cheap. They're going to go back up. No, they stay low and it stays frustrating for longer, right? And so sometimes just because they get overvalued, which as Brian mentioned, it's been there for a little while, especially in certain categories, they've continued to do well and keep growing into that valuation. So by historical reference, yes. Does that mean that changes this quarter or this month or even this year? Not necessarily.
With an anticipated tariffs, will you be pulling back on international exposure?
Yeah, sure. I think yes. Short answer, yes. I think becoming a little bit more domestic focused, but still remaining diversified. We aren't the only people in the room saying the same thing, right? And so if you get to a point also where everybody thinks one thing's going to happen, that's exactly when it doesn't. So we want to maintain a diversification, but look for opportunities to kind of move assets to where we think there's more a cheaper asset point or entry point. But in general, trying to be aware of our international exposure makes a lot of sense, maybe especially looking and reviewing emerging markets versus developed nations makes a lot of sense. So maybe ticking down a little bit, yes, just with the election results that came, but maintaining diversification because we will try and understand that we can't predict where all things are going to go.
Yeah, I think one thing to note too is the international that we do use, we typically tend to choose funds that are very choosy with the international companies that they invest in. It's not necessarily just a broad own the whole international, because I think there will be winners and losers with the tariffs, and it may not, it may hurt some international companies and benefit others. So I don't think you can ignore the category altogether, but certainly being selective and high quality, that's the key.
Absolutely.
Yeah, and last one, should I be buying into this market rally?
Well, I think if you take all the questions we just talked about and smush them together, that's the one question, right? That they all come to. The classic answer, it goes back to your investment goals. I think if you are a short-term investor, you need money sooner than later. You know, I would be cautious if you're investing for the next 30 years. Obviously, you want to have a long-term allocation and a long-term growth style portfolio. So it really depends on the goals, depends on your income needs, that it depends on your personal financial situation. So perhaps depending on what you are able to handle, but perhaps not, depending on your goals.
Yeah, and the only thing I would add to that is that we'll probably see volatility, right? A lot of these new policies are going to be coming in waves. We know a little bit now, we'll know more in a month, we'll know more in a month after that. And so in the same vein, you know, dollar cost averaging into volatility can make a lot of sense, right? So we're not necessarily just taking a position on the market today, but over time, continue to dollar cost average as rates move and as we get more clarity on things. But I think that's always a prudent strategy. It removes volatility, it removes risk if you kind of dollar cost average over a period of time.
They're great questions. It's a lot of fun.
Well, thank you for joining us at our Capstone Coffee conversation, and we will see you again next month.